Here is another ET Now exclusive. The SEBI board meet is on the 21st of August, and strengthening mutual fund regulation tops the agenda. In fact, sources are saying that the market regulator is tightening rules for debt and liquid mutual funds to avoid future shocks, like in the recent cases of exposure to Essel and DHFL. Now, this is something, by the way, which had already come in the case of liquid funds. This was, of course, with respect to not just MTM, but also the fact that they'll have to keep a certain amount of their, assets or their corpus in cash. Now, of course, it is being... they are becoming even more stringent with debt mutual funds as well, and of course liquid mutual funds. And Nayantara joins us now. And Nayantara, it was already the case if you hold papers that have a maturity of under 30 or 60 days. But now I think what your understanding is that it is going to be for all instruments that are held by the debt or the liquid mutual fund, isn't it?
That's absolutely right. And there will be no amortization that is perhaps going to be allowed. So this is the big story, folks. See this as a lesson that may have been learned from recent instances of debt mutual funds, to organizations like, let's say, the Essel Group, DHFL, Yes Bank, all of that, where the unit holders have also been seen on the wrong side of their investments. So we are being told by our sources that when the market regulator SEBI meets at its when the next board meeting takes place on 21st of August, topping the agenda is amendment to regulations for the mutual fund industry, particularly the debt and liquid funds. If I could just actually put it and sum it up for you in one headline, let me say it like this: expect new investment and valuation guidelines when it comes to debt and mutual funds. Mubina, I'm going to begin first with the valuation aspect, because really it has been with the valuation aspect where this entire issue has come to fore. You brought up these relevant points, about mark-to-markets. I'm being told by my sources that debt mutual funds have to completely shift to mark-to-market valuations, and that's going to be from effect of 1st April 2020. They're not going to be allowed to amortize the valuations of debt as well as money market instruments. So basically, maybe, and I'm sure we're dialing experts, that could help in prompt diagnosis of unit holders' valuations. Even if they can't exit given the fine print, at least they will know where their money stands at, what their valuation is. The second part is that, you have current provisions to NPAs. Now, that could be deleted altogether. There could be a new methodology, new guidelines for classification of assets. So when it comes to the bad assets, we're being told it could fall into 3 of them: under investment grade, below investment grade, and default. I'll repeat that for the benefit of my viewers: under investment grade, below investment grade, and default. I think the first one should actually be just investment grade. So these are going to be the 3 parameters. You do away with the NPA provision. So, Mubina, I've now taken you through what the valuations will be, but I would also like to tell my viewers that what can also change is the investments that debt mutual funds and liquid funds make. So they may only be allowed to invest in listed or to be listed equity and debt securities. I'm going to repeat that for the benefit of our viewers, because this could also be a big change. Mutual funds may soon only be allowed to invest in listed or to be listed debt securities. This change could take place in phases that the SEBI board will decide on when it meets on 21st of August. And it doesn't need to amend the law for this. This change could actually come out with just a circular. So it can be announced as soon as the SEBI board feels it should be announced. Second part, when it comes to unrated debt, you could look at an exposure, the cap being reduced from the current 25% of NAV to nearly 5% of NAV. They will be reviewing the unrated debt limit periodically. So, ladies and gentlemen, I've taken you to some of the highlights of what's expected at the SEBI board meet on 21st of August. New norms for investments and valuations by debt and liquid mutual funds. I believe Feroze Azeez is now joining us on the phone line. Hi, Feroze. Good afternoon. This is Nayantara Rai in New Delhi. I don't know when exactly you tuned in. I'll begin with the valuations first. Complete shift to mark-to-market valuations from 1st April 2020 on the cards to do away with amortization. Good or bad? What is this exactly going to mean for unit holders and fund managers?
relevant from a liquid fund perspective. Mark-to-market is nothing but a phenomena of actually pricing the security on a daily basis rather than pricing it on the face value and the accrual of interest. So very good for investors, but it will marginally increase the volatility of liquid funds. But that has already been in a graded fashion brought down. So not a very large impact, especially on the rest of the debt fund categories, because the rest of them are generally on mark-to-market any which way. Only liquid funds had some degree of non-mark-to-market papers up to 1 month and 3 months. Now they will also be into mark-to-market category, which will increase the NAV's volatility marginally.
So it could increase the NAV volatility, but from a corporate governance point of view, or from the point of view that you can't amortize, would it also help in early recognition of which way a fund is headed? You know, there's entire talk of how there have been certain negative returns and other kind of returns that had been anticipated. Could it check that you at least know the situation early on? Look at what happened with Essel, look what happened with DHFL, look what happened with exposure to Yes Bank, for instance.
Correct. The amortization. So what used to happen is, because the one is that you don't know where the fund is headed, like you rightly pointed out, Nayanthara. The second problem is the investors who exit take away a larger share than they deserve. So short-term investors were taking their money at the cost of long-term investors, because when the investor stays on for longer periods of time and then the accident occurs, like all the names you mentioned, then he is getting an unfair share of a larger hit on behalf of another investor. So this will help all the risks taken by a specific individual investor being passed on, benefit or a loss to that person, rather than the residual investors in the fund.
What about the new methodology when, you know, SEBI is considering to do away with the provisions to NPAs, come out with a new system for classification? There will be 3 parameters: investment grade, below investment grade, and default. How is this really going to help? Is this going to strengthen the mutual fund industry? And the very fact that mutual funds will only be allowed to invest in listed or to be listed equity and debt. That should take care of also the problem maybe we've seen on mutual funds exposure to promoter entities?
Yes, I think what's on the unlisted and listed, what used to happen is people were doing a lot of structural debt with different corporates. And sometimes these structured debt obligations were not listed. Because to list a debt security, you need a specific criteria to be fulfilled. So now I think it will be good that you're going to have listed securities. They go through a little stringent regulatory framework. So it'll curtail the hands of the portfolio managers, but for the good, and will bring down the risk substantially, to my mind. If you look at unlisted papers, largely those are in accrual funds and credit risk funds. The proportions of unlisted security is larger, so there will be a rejig in the portfolio in the months to come.
Okay, Feroze, you know, we look forward to bringing you back on the channel to discuss this more in detail. But today is a day where the markets, you know, the equity markets deserve to have all of the spotlight, especially the carnage that we saw overnight from Wall Street and what's happening in the rest of the world. So maybe now with that, it's back to you.